The first question that came in, we're going to talk about long-term income strategies for extra protection while still meeting our goals. We're talking about covered calls, naked puts, and long collars. This is a direct question that came in from Mike E. And earlier, Mike E had sent in an email that says, can you please discuss the best ways to use the simulated CDs under your covered calls section of the website? This is a default search that we offer on Power Options. It also comes with a tip sheet that discusses the use of this particular screen. What are the simulated CDs? It's a default search on our covered call screen. It's looking for far out in time covered call positions, at least 180 days out. Most of the positions that come up are 370 days out in time up to 700, 1 or 2 years out in time. It's an in-the-money covered call structure that offers a high downside protection as well as a high potential percent return. It's almost a fire and forget position. We'll talk about that in just a moment. The true description Ernie put together for the simulated CDs. The theme of the simulated CDs is to use long-term options to earn income, provide high downside protection without the hassles of having to write options each month. This, of course, was originally created before the weekly covered calls came to be. And still, weekly options, excuse me. And again, those weekly options at first only started off with 5 or 10 positions, and now we're up to about 600, I believe, stocks, indexes, and ETFs that offer weekly options. The options are expire 1 to 2 years out in time, are in the money for a high probability of being assigned. The returns, even if the stock stays the same, tend to be in the double digits. They're starting off in the money, so you'd still be assigned. We look for mid to large cap stocks, have a relative PE of less than 80, and a stock price under $100 per share. And again, there's a full tip sheet that discusses this as well. But let's take a look. What are the basic criteria? Again, we're looking for covered calls that are at least 180 days out in time, but they can be much further out as well. And anywhere above 180 will appear in the results if it matches the other base criteria. Basic return of just greater than 7%. Most of these are in the 19, 22, 23% range. And we're looking to be at least 15% in the money, which gives us that higher probability of being assigned. We are looking for stocks that are in an uptrend, and as was mentioned, a relative PE between 10 and 80, and looking for mid to large cap stocks as well. The default stock price range is set to be between 9 and 100, of course, but you can change that at any time, just as any of the criteria on the basic search. What do the results look like? Well, from today at 2 o'clock in the afternoon, here you see the basic results that we had from the simulated CD search in the covered call search tool. We have Revolve Group at 35.36. We can sell a 2022 January 30 call for a midpoint maybe around 11.60, bid at 11.30, ask of 11.90. Well, that 35.36 minus the midpoint would put us at a total cost of 23.76. That's the break even on this covered call, which means the stock can fall almost 33% before you're losing money on the position. And if Revolve Group stays above 30 over the next 371 days, you're looking at a potential return of 26.3% for a 371-day trade. It's not too bad, is it? It's about 1.2%, 1.1%, I should say, per month. So sort of a fire and forget trade. Other ones here, Canadian Solar at 52.23, a deep in the money January 40 strike call, the midpoint of around 19.45. This is going to put your net debit at 32.78, which means, again, you've got about a 37% downside protection. The stock can fall 37% before you hit the break even, and as long as it stays above 40, you'd make the return of 22% on the position. Okay, so, all right, let's see here. Okay, so I'm checking something. I apologize real quick. All right. Okay. All right. So I just looked at the two questions that came in. Again, we're going to get, I'm sorry, William. Yes, it's 2% per month. I'm sorry, I said 1.1. So about 2% per month. Okay. All right. Okay. So I was looking for some of these questions. So my apologies there. Yes, it was 2% per month, 2.1% per month, roughly. And Fernando poses a question here. Well, aren't you going against the ATM bell curve? Well, the idea here, Fernando, is not to maximize the return in the sense of following the ATM bell curve, and it's not looking to maximize the return as far as the general rules, meaning what? Well, when I'm selling, to maximize annualized return, I want to be selling month by month or week by week. When I'm buying, I want to be buying farther out in time. You're right, Fernando. This goes against both of those concepts. So why would we be doing it? Well, let's move on to the presentation here. We'll explain why this is done. So here's just the standard profit and loss chart for the CSIQ quote unquote simulated CD position. Buying stock at 52.23. Selling that January 40 call midpoint roughly at 1945. As long as the stock stays above 40, 370 days from now, we make the 22% return, 722 off of that true investment of 32.78. The stock price plus minus, I should say, the premium that we receive. Now, what are we missing? Number one, there's a lot of impression that, well, if I enter this with this January 40 call far out in time and I collect 1945, if the stock falls down, to 46, 47, maybe even 45, we'll be able to buy back the call and maybe even roll it or adjust it. And the trick is with these 1 and 2 year out options, you don't see that. Not related to the ATM bell curve that Fernando mentioned that this does go against, but is still prudent for covered calls to be in the money for the higher probability of being assigned. We're out here, roughly. We're over here in the S's, okay? We're 371 days out in time. So even though the stock's going to fluctuate, we might lose intrinsic, we might see some price changes, but you're not going to start seeing time decay where you can buy back at a reasonable profit until you start getting into that 90 days to 60 days to expiration. We're talking about September, October, November, really, for this position. This is kind of a fire and forget trade, meaning that you put the trade on and you close your eyes. You walk away. If you're concerned, when would you use it? How would you use it was sort of related to the direct question that came in from Mike. Well, if you're concerned about a current downturn, you want to get some income now. And you don't want to worry about trying to roll down the covered call if the stock falls 4 or 5%. You're not trying to worry about adjusting it every week, every 2 weeks, or every month as trying to sell a weekly covered call that would have a higher annualized return, or even a monthly that potentially has the higher annualized return if all things go in your way. If you're one of those investors who likes to take a portion of your portfolio, enter trades, and not pay attention to them, not touching the position, don't have to worry if the stock falls 20, 25% because you're still in the money and you're still at a break even. Just let it go for 12 to 13 months and let it be assigned. I had a conversation. Who uses this the most? My opinion, it's financial advisors. We have several financial advisors from different groups that use this approach. What are they doing? They show their clients that we got you into a stock and immediately we generated 15, 20, 25% of premium against your stock price right away. The advisor can have 40 clients. Those clients can have 20 positions. He enters them this way. He doesn't have to do anything for 9 to 12 months. Just leaves it alone. Yeah, he's probably got an alert somewhere that if the stock falls 15 or 20%, he's going to do something for his clients. But in most cases, even then, the simulated CD is still probably above break even, still probably might yield them that 15, 19, 20% return in the next 371 days. Okay, so yes, Fernando, this does go against the concepts of the ATM bell curve, looking to sell at the money to maximize the time value. This concept does go against the time decay, where I want to typically be selling every 30 days or every 14 days in spreads and other positions to take advantage of the rapid time decay in my favor. And at the same time, it goes against that general rule that we get the better annualized return selling month by month or week by week. But this is an approach, lack of a better term, that's fire and forget. Put it on, be done with it, walk away. Of course, it does have a parity trade, as do most things. You could do this with a deep out-of-the-money naked put that's 300, 350 days out in time. Same strike price and expiration. In this case, on CSIQ, sell the 2022 January 40 put. We're only going to get 685. But that's all time value. That means the break-even price is 33.15. Okay, that compared to the net debit of the covered call with the same strike, which was 32.78. So the covered call is more premium. You can see that too. This would give us a naked yield with the cash secured naked put of 20.7% versus 22% for the simulated CD covered call approach. The percent to break even is similar, meaning that our break even is at 33.15. CSIQ can fall 36.7% from where it is now before we may start losing money on this position at expiration. Keep that in mind, of course, versus a downside of 37.2% of protection looking at the CSIQ simulated CD covered call with the lower break even. But it is a parity trade. And of course, one of the main differences of doing the simulated CD we were just talking about versus doing this naked put approach is if you're looking at a dividend paying stock, you'd miss out on the dividend. So you'd probably want to use that as a simulated CD if it's your approach. On the flip side of that, the continuing conversation I had with the financial advisor this week that uses power options for his clients wanted to talk about a little bit more risk control. Sure, stock could fall 25, 30% before you hit break even, but what if he wanted to curb that more? What if he's worried about a 50% drawdown on a more volatile stock, depending on how the market goes over the next 12 to 13 months? Well, another approach might be a collar position. Standard collar, far out in time. With the proper structure you'd want, of course, you're going to have a lower probability of success in this case. You're not going as deep in the money. And we don't have a higher return, but we're close to a 1-to-1 risk-reward ratio. Here we see the structure of buying 100 shares of CSIQ, again at 52.38. We're going to sell just slightly in the money, at the money. Again, Fernando taking advantage of the at-the-money bell curve there. 50 call for 14.45. And at the same time, buying one contract of the January 40 put for about half the price. That's what I'd look for in this structure. Finding the put that only takes away about half of the premium. The return is half, 11.7% if we get assigned, but the most you can lose, even if the stock falls to 40 or 35 to those other break-evens, is just 10% on the position. Of course, in the covered call, the simulated CD are still protected below that as well. But if you want to show, the reason why we brought this up is that if you want to show someone or if you want to have a 1-to-1 risk-reward ratio, in this case with protection, you could still potentially make 11.7%, not risking more than 10% true 1-to-1 risk-reward ratio in that case. Okay? All right, so let's see here. Okay. Okay, I'll get to that on our discussion in just a moment, William, okay? Let's just review this real quick. My apologies. So, how to use them and why would you use them? The simulated CDs offer the potential for a strong return. Because of the high premium, the range in the money, you get a very strong downside protection. You have a very favorable break-even price. You would rarely even think about adjusting this position. You're literally leaving it alone, almost closing a blind eye to it, for lack of a better term. You're not going to see a lot of time decay because it's so far out of time. Those of us that are maybe a little bit more active trading, we like to do some spreads, we like to do some weekly options. A whole portfolio of these might drive you crazy because you're probably not going to take a look at it until September or October, 9 months, 8 months away. Not bad to just walk away. Not bad for a portion of your retirement portfolio based on market conditions. It doesn't hurt to check the parity. That naked put offers a similar risk-reward profile to the far out in time simulated CD. You would miss out on the dividends, of course, and you have a smaller chance of early assignment, but that shouldn't matter. If I did that simulated CD, where I could potentially make that 26% return I think we were looking at with the CSIQ position, because I sold an in-the-money 40 call, if for whatever reason I'm assigned early, okay, I made 26% in 4 months instead of 13. I will take that. But again, if it's a long-term position you're using with an in-the-money far out in time covered call in a stock that pays a dividend, if you get assigned early, okay, you're going to miss the rest of that dividend, but you're still going to be happy with that return as well. But we're out of the money with the naked put, remember. The parity is reversed. So we're out of the money. So in that case, don't run the risk of early assignment. And it always isn't a bad idea to look at the long-term collar. Offers a good return, 1-to-1 risk-reward ratio, higher break-even, at a lower probability. Higher break-even is a negative in this case. It's a much higher price. Look at this. Let me go back to the collar structure for just one moment. And William brought up a question, and he had mentioned, I'm sorry, he had another follow-up that we'll get to as that as well. There we go. Okay, so William says, instead of a naked put, what are your thoughts on a really wide bull put credit spread using the same long dated expiration and the same short strike? To me, this requires a lot less capital. You're absolutely right. If we sold the 40 put and bought the 30, we're not going to get as much premium. Remember, it was 685. We'd probably still, even at 10 points apart, we're going to be paying half of that. Okay, so we're only getting 385 on a risk of 10, but that's still a 30% return. That's using the leverage. The break even wouldn't be as low, naturally, right? We talked about the break even for the cash secured naked put at 33.15. So if I take $2 or $3 away from it naturally to create the bull put credit spread, in that case, that would put the break even up to say 35.15. Okay, so against the 40 strike with say a 35, you do a bull put. It would have, you could structure it very similar, because if you think about it, William, and I know you do, what we looked at before, this collar structure would be very similar to what we're looking at as a bull put, just not as deep out of the money. And for the bull put, if I sold the 50 put and bought the 40, we'd be risking maybe 478 to make 522. Be a 1-to-1 ratio again, but with only that 50% probability. Selling the 40, buying the 35, probably put us in the 300, maybe 400 range of profit here. I'm sorry, 40 to 30 in that case. So we'd have more of that structure as opposed to the naked put. We'd be taking a fair amount away from it. And William's follow-up comment in that is, I kind of like this strategy. Nothing wrong with this 2% per month. Plus, I could go with the golfing every day. That's exactly right. And that's why people use it. And the most common investors I talk to that use this strategy, again, are the financial advisors, so they can show their clients that return right away and just leave the position alone. Do other things for their other clients that aren't trading options. They've shown a return already. They've shown a good downside protection on the position and more. That's for the covered call approach, owning the stock, selling a call against it, instead of doing a shorter term, which will give you a higher annualized return. The simulated CD is a way to essentially have, again, that fire and forget position.